Hello and welcome to BQ Prime. Today's Monetary Policy Committee resolution was largely on expected lines, with the MPC continuing to retain the benchmark repo rate at 6.5%, and the stance also was maintained at what it was earlier. What was a little different was that while GDP growth forecast for FY24 was maintained at 6.5%, inflation forecast for the full year saw a very modest revision to 5.1%. Now, to share their thoughts on today's policy, we're joined by Mahendra Jajoo, CIO Fixed Income at Mirae Asset Management, Siddhartha Sanyal, Chief Economist and Head of Research at Bandhan Bank, and P. Rajagopal, Executive Director for Bank of India. Thank you so much for taking time out today. In conversation with me is also Jaspreet Kara from BQ Prime. Jajoo, sir, I'd like to start with you. So it would be fair to say that today's policy was largely on expected lines for the market?
Yeah, I would say so. The policy was largely in line with the expectations. So no one was, realistically expecting any change in the policy rates. There was some hope in the market that the Reserve Bank may give a slightly more positive guidance in view of the fact that the inflation numbers have fallen rather sharply and the oil prices have also come down. But one was a little bit, in to that extent, surprised by the emphasis on the 4% target, and that
Absolutely.
the global environment is still very, very uncertain. So effectively, this policy has, kind of dashed the hopes for an immediate rate cut. And I think the guidance has been towards a extended pause, and that, in that sense, has killed the expectation of any further significant movement in the markets for the time being.
Absolutely. Mr. Sanyal, what did you make of policy today? As Mr. Jajoo pointed out, and Governor Das too reaffirmed on multiple occasions today, that while inflation is very much within the target range, it is still not on target. That's 4%. And it's not expected to, stay in that target with FY24 expected to be at 5.1%. So what was your takeaway?
No, I tend to agree with Mahendra, what he said just now. I think very clearly that on the rates front, which had been in focus for last so many policies, it was kind of a foregone conclusion that they will be staying on hold, and there is absolutely no surprise that the MPC has delivered on that particular front. At this juncture, there was a bit of a focus on whether there is any change in whether we see any change in the stance of the policy or any significant change in the growth inflation forecast. Our expectation had been that there won't be any change, and very clearly there was no change in the policy stance. Very modest change in the inflation expectation, inflation forecast. So that part is absolutely fine. I think at this juncture, when after a phase of quite a bit of active monetary policy in the last several months, when we enter a phase like this, when possibly we have to stay on hold for a significantly long period of time on the part of central bank, managing and anchoring markets expectation is very important. And my sense is that they did that particular thing beautifully this time. That, okay, I'm done. I'm most probably done with my hikes immediately as things stand now, though I'm not taking anything off the table. But don't expect me to ease anytime soon. I'm good staying on a wait and watch mode, possibly for a fairly long period of time.
All right. So, Mr. Jajoo, considering that the expectation now is of a prolonged pause, where do you see the bond yields heading from here in the near term? Do you expect a little bit of softening in yields? And if so, what's expected to cause that?
So, in the anticipation of a rate cut in due course, the bond yields have already come down quite significantly. So, as against a repo rate of 6.5%, the 10-year yield has already been trading below 7% for the past couple of weeks. And the yield curve, especially in the corporate bonds between 5 to 10 years, had become slightly inverted in the sense that the 10-year yields or the longer yields were 3 to 5 basis points lower than the middle sector. That was also partly done by the huge demand from the insurance and pension funds who typically prefer the longer end of the segment. So if you look at the historical data, typically the 10-year yield tends to coincide or get closer to the repo rate before the rate cut starts in anticipation in the build up to the rate cut cycle. So that process was on, and many people including myself were expecting that maybe a 10-year can inch towards 675. But now that the period for which the Reserve Bank may remain on pause is looking like getting a little bit extended, the room for the 10-year yield to come down from here may somewhat limited. And at the same time, it's not as if the whole scenario has become very negative and the inflation is going to go back up, etc. So the optimism and the positivity remains, which means that the room for the 10-year yield to move much is not there. So I expect the 10-year yield to trade in a narrow range of between say 695 to 710 over the next quarter, by which time we have more guidance from the Fed and the Reserve Bank.
Right, because you mentioned the Fed and there's an interesting move with global central banks going on. If I can just jump in here with a question for all three of you. In recent days, we saw Australia and Canada return to the hiking cycle. Bank of England and ECB are expected to deliver one more hike in the upcoming meetings. The Fed may or may not hike, but if we were to assume for a second that the Fed does a 25 basis point hike here, the difference that we're seeing across the board emerge both as a premium and as the differential in yields. Do you think that may impact how global investors look at India as an investment destination? Does that change their thinking about risk? And if I could add a fact here as well, Japan is seeing some macro movements as well. So that's come back on the radar for global investors as well. What's the outlook for all three of you when it comes to things like this?
So I don't know in which order to answer. So let me just take it first. So I think the one of the important factor because of which Reserve Bank has perhaps given a little bit lesser than expected supportive guidance is that there are two major central banks, the Bank of Canada and the Reserve Bank of Australia, who have gone on pause and they have hiked rates, which means there are a lot more uncertainties and the inflation is far more entrenched than was initially expected. Fed, in my view, will pause at the next meeting. But then, like with RBI, Fed is going to just say that oh, we are done, because no central bank will preempt in that sense. And when we're talking about differential, we are looking at the the differential between the yields. But then let me just put another picture for you that today the Reserve Bank is projecting an average inflation of 5.1% for 23-24. Fed is projecting an inflation of 3% for end of 23 or quarter of 24. So then if you think about Fed at 5.25, RBI at 6.5%, US inflation at 3%, and then India inflation at 5%, the picture doesn't look comfortable at all. And on top of that time, if you have a recession or if the equity are a little bit volatile, there is an FI outflow. So there are a lot of things which are still not in a high comfort zone, and therefore I think the yield differential on a nominal basis is one part, and on a inflation adjusted basis may be still uglier. And that's the reason I think RBI is very correctly on the guard right now. They are not allowing, or they are not projecting at least over optimism on the rate front. I think it's a very well balanced articulation of the situation.
Mr. Rajagopal, if I can get you in on this as well, what are your thoughts about the growing differential? And then I want to come to a question about liquidity later as well. But can we start about this?
Yeah, I largely agree with Mahendra in this. He's right in saying that there is still huge yield differences. Differential is very high. And apart from that, India continues to be a very important destination for global investors, despite the fact that others have higher rate. That is a great advantage. Yes, economic outlook in terms of GDP. Today, India continues to be the largest and fastest growing economy in terms of GDP numbers compared to the others. And then the advantage is we have very strong domestic demands in our spiraling our growth. So naturally, the issues will not be there simply because the other markets have right rates, and doesn't mean that no investment will dry up. If you see the FII numbers and FDI numbers that governor has rolled out in his speech, so they are still robust. So there is no problem. I fully agree with what the Jajoo says. There is a lot of an opportunity, but as he rightly says, again, governor has reiterated that it is not a pivot; it is continues to be a pass. So it appears to be a very long pass. And then because of the hawkish stance on the margins, like somebody was saying TV today, that it is hawkish stance on the margins. It is nothing but stance on the margins because the RBI is unwilling to cut rates unless they are comfortable with the inflation. And they are not happy with the inflation trajectory. Simply because inflation in the trajectory, they will not cut the rates. They say, I want to reach 4% to cut the rates. If that is the step they're going to take, and we see a very stable rate climate for quite some time, at least for the two policies, I see a very stable rate climates.
Okay. Moving from something that's been pretty stable to something that's been pretty topsy-turvy over the last couple of months, at least, banking system liquidity. Now, the governor himself highlighted a skew that we're seeing in banking system liquidity. I just want to understand from you, how severe is this skew? How intense is the slant in favor of big banks when it comes to liquidity? And if you may, what might it take to change that skew as well, to maybe reduce that skew somewhat?
See, what happens is, if you see the liability profile of most of the bank, market shares are all predetermined in the sense that we cannot go beyond a point, because today the market share of SBI and others are always huge. So naturally, it will continue to be skewed. They continue to be the net lenders in the market even today.
Yeah.
So most of us are net borrowers in the market.
Yeah.
We manage our liquidity based on whatever profile we have in terms of that. Accordingly, our asset growth and credit growth also will be anchored to that. Naturally, we manage our liquidity completely differently from other banks. So skew liquidity cannot be changed immediately, because it all depends on the size, balance sheet size. So the HDFC is mopping up huge amount of deposits.
Yeah.
Okay, is mopping up huge amount of deposits. The way they interfere in the market is completely different. So the way we operate is different. So skewness will continue to remain, and we have learned to manage this skewness.
Okay, I'm sure you have learned to manage the skewness as well. I have a quick follow-up question on this now. There was some conversation in the middle that, when it comes to tighter liquidity conditions like we saw in May and April somewhat, there's some reticence on banks' parts to go to the MSF and access that funding. Is there a need to destigmatize the MSF to any level, do you think, or do you think that's not a concern?
Basically, see, I'll tell you, most of us hold excess SLRs of almost 2.5%, 3%, 4%. So our borrowing is mostly from TREPs. So our TREPs borrowing will help us in terms of managing our asset side as well as in the liquidity also. So we don't need and we don't go to MSF as such, because MSF is costly for us. Okay, so we don't go. See, ultimately, when you look at the weighted average borrowing cost for the bank, both in terms of our on the GSEC as well as the deposit side, I don't want my cost to go up beyond a particular level, which we internal limits. So we always choose between TREPs, refinance, or going to MSF, and MSF is always a big problem for us. Again, you'll have to borrow bulk to repay. All those things are there. So you cannot manage your liquidity on the basis of MSF. You have to manage based on your excess SLR and your core liabilities.
Right, certainly. So yeah, that sort of is not a very appealing window, you would say. Okay, Pallavi, back to you.
Mr. Sanyal, I do want to ask you a little bit more about the RBI forecast for inflation. So while there has not been much of a change to the full year forecast, the central bank has brought down forecasts for the first 2 quarters, whereas the next 2 quarters don't see as much of a change. So, I mean, what is that indicative of? Is there cautiousness around the progress of the monsoons? What are the factors at play here?
Yeah, I think there is very clearly a bit of cautiousness. I think that's absolutely prudent and justified, because at this moment we are dealing with many moving parts within the country as well as globally. And at this juncture, we have relatively less clarity and visibility about inflation forecast a couple of quarters down the line. At this moment, we have seen a bit of quick softening in inflation numbers for the quarter that has for which data flows have begun, and we are more confident where they are very confident. They have cut it down by about 50 basis points. Where they are not, they have just stuck to their current forecast. So overall, it makes absolute sense, and my sense is that they will continue to be like this. They will rather be lagging behind in terms of reducing or lowering their inflation forecast anytime soon, rather than that they will be waiting for a little more clarity. Just wanted to, also touch upon one particular question that just asked a few minutes back. That what is the implication? What is happening among the global central banks' decision in terms of reversing that? I think one very, very important data point or information that is waiting for us is later this month from the Fed. I'm not necessarily referring to their rate decision, which generally, as Mahendra also mentioned, our expectation is that we expect them to stay on hold in this particular policy. What I'm much more interested in looking at what the dot plots will be suggesting this time. The dot plot we have seen last time in the month of March. At that point of time, 11 out of 18 Fed governors had indicated they do expect just one more hike in this particular year, which was eventually delivered in the month of April. Now the question is, we get to see with a lot more data in hand that what exactly they forecast in terms of their own action going ahead over the course of the next 6 months. If the largest central bank continue to say that, okay, we don't expect too many changes or too many Fed governors do not expect one more hike or further hikes at this juncture, especially if the 7 governors who expected more hikes, if some of them moves lower, I think some of those points will be extremely important as a guidance for all emerging market central banks, if not for all global central banks.
Okay. Just a quick follow-up, because you mentioned the US Central Bank. Do all three of you have any target date in mind for the US to get to 2% inflation? Because I know the stated objective is 2%. I've heard things like the next 6 months to not before the next presidential election. I would love to get your outlook as
well. I think of late, none of us have really thought about that for a while. So we have to really go back to the drawing boards and check. That seems so much far away at this moment. But I think on these things also, the situation may change depending on several macro factors. Of late, we have seen macro parameters surprising us big time. Now the question is, when we get some bit of clarity or even expectation of a 2%, whether that will be out of a good set of developments or not so good set of developments. I think that is the key. If there is a big recession hitting US, because of that, the global commodity prices take a beating, and because of that, we see a 2% or a visibility of that. That will be a very, very different scenario compared to a general anchoring of inflation, it rolling down. That possibly gives the Fed a lot of headroom to move ahead with a much more stable policy situation. I think that will be the key rather than just the number.
Okay, understood.
Okay, so Mr. Jajoo, any closing thoughts? And also the inversion in bond markets that you mentioned, is it something that we expect to ease going forward? What's your outlook?
No, sure. So just quickly, what Siddhartha was also, and I think the timeline in terms of when to approach 2% is not important. And as we have seen in case of the Reserve Bank also, when the central bank feels confident about achieving the target, I think there's a time of thinking about going on or on in terms of reversing the policy stance, because it's important that the visibility is there. It's not important as to reach the duration. The second, in terms of the inversion, I think the inversion is a very common response to an expectation of a rate cut, and the rate cut expectations were rather optimistic and in the bond yields coming down. In case of India, the curve was not, inverted in a material way. I mean, in US, for example, the curve is precisely inverted. So the market expression of the central bank having to cut rate was very strong. In countries like India, it's very difficult to have an genuinely inverted yield curve. But I think all of us as market participants look towards US and then trade. So we tend to follow their pattern. And with that, we saw the curve getting absolutely flat. In case of corporate bonds in particular, we saw a little bit of inversion because of the huge demand from the insurance companies. So there, the inversion is not necessarily an expression of the market view, but of the fact that there is no interest or very little interest in 5-year segment compared to 10 years. I think with the today's guidance, inversion will tend to get removed, and there will be little bit of flattening of the yield curve, and that can happen by the 10-year yield going up by 5 to 7 basis points.
All right. Thank you so much for joining us, all three of you. This was a most insightful conversation. Thank you very much. Stay tuned to
Thank
BQ
you.
Prime.